So quick introduction. So welcome everyone to the latest installment of our education program here at Westwood 360. I see a number of familiar faces, so nice to see you all again. For those of you whose first time it is joining us, we've been doing a monthly webinar series just on a variety of different topics that are really just pertinent to all of our boards, regardless of whether you're incorporated as a condominium association, a townhome community, a single family home community. All these things tend to affect everyone in a very similar ways, sometimes nuanced different ways, but trying to focus on topics that just make you empowered to be the best board member you can be, especially when we talk about some of these things that impact your budget as you're going into 2026 planning, and then anything that just helps you get more empowered. So when homeowners are ever asking you questions, or you're reviewing proposals, or your meeting materials that your managers are sharing with you, we just want to always make sure that our boards are always having a better frame of reference for all of those things. So with that said, tonight we will be featuring our partners and great industry experts over at Community Risk Advisors to go over the ABCs of insurance, including some of the takeaways in terms of the policies that you need to have, some of the optional policies that we often get questions around. I know there were a number of the pre-submitted questions from some folks about some of those things that are more ancillary and not every association has. So it'll be exciting to get into that. And then a peek into what 2026 is looking like in terms of planning. So just a quick recap. I'm Eric Stazak. I'm our Executive Vice President at Westwood 360. I've been with the organization for almost 13 years now, in a variety of titles, but in some way, shape, or form have been responsible for our association management division. And then if I could, Alan, Tyler, and Chad, if you don't mind introducing yourselves, and then we can get into the presentation.
Very good. All right, I'll go first. I'm Tyler Robinson. I am our Vice President of Corporate Relations at Community Risk Advisors. Been in the insurance industry for about 8 years, certified insurance counselor. And I've been focused specifically on community associations for the last 7 years of that.
My name is Alan Hudson. I'm the president and founder of Community Risk Advisors. Like Tyler, I've been dedicated entirely in common interest community, property and casualty insurance. I have a broader real estate background. But again, yeah, everyone at CRA is an insurance counselor or a certified risk manager, and focuses almost exclusively on multifamily HAB and the vendors and managers that serve them.
And I'm Chad Buffa. I'm the Midwest Director of Operations. I've been in insurance for almost 25 years now, with a little over 15 of it dedicated just to community associations and other property coverages, habitational.
Excellent. Thank you, guys. And then Alan, Tyler, Chad, do you want me to share on my end, or what, do one of you want to share on the presentation? Either works for me.
Yeah, I can go ahead and share my screen. I have the presentation up. So without further ado, let's get into it. All right, everybody. Well, first and foremost, thank you so much for taking time out of your evening for what is, I'm sure, the first topic on your mind in regards to insurance. Very exciting. So tonight we're going to go over some insurance ABCs and also a look ahead at the forecast for the 2026 market. Some exciting new developments coming in the industry, and looking at some trends. So with that, we've already gone around and introduced ourselves, so I won't belabor that point anymore. All right, so game plan for tonight. This evening, we are going to talk about why insurance matters to your community, and even matters more than you may think. We're going to go over some must-have coverages. We call them our core four. And Alan is going to take a little bit of a deep dive into the 2026 market shakeup and what is coming. And then we're just going to go over some best practices and smart moves for even smarter communities. Our entire goal here at CRA is to empower you all as board members, as community managers, as just general leaders within your community to make educated decisions. So we'll go ahead and get into that. All right, this right here, this slide is just a little bit of who we are at CRA. I'll give a high level overview and then Alan can feel free to jump in if he'd like to. But Community Risk Advisors, we're an independent agency focused strictly on multifamily habitational. So your condominium associations, homeowners associations, property owners associations, any sort of common interest community, and also the vendors that support that community. We have access to many different carriers and carriers that are well aligned with our goals in providing coverage for community associations. Why do we do that? Provides us better access, provides us with carriers that tailor their coverages to fit the risk profile for your communities and just deliver a better overall product. Alan, do you have anything you want to add on that, or?
No, just that, an agent to represent an insurance company has to be appointed. And many insurance agencies acting in a generalist fashion can only be appointed with a certain number of carriers. And oftentimes those generalists are appointed with generalist insurance companies like your Liberty Mutuals, your Travelers. To specialize means that, we're able to access carriers that a lot of markets may not have access to, a lot of agencies. So there is some truth to the whole, like, we have markets that others don't kind of thing.
Excellent. All right. So moving forward, and just to clarify everything, we want tonight to be very interactive, very open. We want it to be an open dialogue, hopefully fun at some point. If insurance can be fun, I hope to prove that it can be. But in any case, any questions, feel free to tell me to stop talking and happy to answer. So moving forward, this is just a little bit about the awards and recognitions we have as an agency. It's not meant to be an exhaustive list. Some of these things probably make no sense to anybody, but as Alan said, most of our team were certified insurance counselors, certified risk managers, CAI educated business partners. So we've got a hodgepodge of experience and knowledge within the industry. All right, so diving right into it, why insurance matters. So as you see at the top, insurance is not simply a line item in your budget. And we understand that insurance typically is one of the larger line items in your budget, but it's not simply that line item. It can also be a lifeline to help your community in the event of loss, in the event of chaos, etc. So a little bit about it. What does insurance do? One, insurance protects what your community has built. Rome wasn't built in a day. Your community isn't built in a day, but insurance is there to protect your community, your assets, your leaders, the structure of your buildings, etc. It's designed to shield your volunteers and decision makers. Oftentimes boards and community managers have very difficult decisions to make. There's coverage there to protect you all in your capacity as board members and community leaders. Covers liability risks. Hey, we've all heard the story of somebody walking down the stairwell in the community, in the building, and they trip and fall. We're here to protect that. Keeping your operations running through chaos. When pipes burst, insurance is there to respond. And your broker, as your advocate, should also be there to respond and guide you through the process. Insurance can build trust with owners and lenders. Everybody loves getting the call from the mortgage lender telling them something or other about the insurance coverage and having to go back and forth 10 rounds. If you have good coverage with a comprehensive policy, it's there. The lender can trust that it's there. And finally, it meets your legal and fiduciary obligations. Your governing documents lay out requirements for your community. Insurance is there to meet those obligations within the governing documents. And then the last item, strong insurance is strong governance. Any community, it's critically important to have a comprehensive coverage program to protect your community. Any questions so far on that slide?
I just want to chime in and emphasize the importance of meeting legal and fiduciary obligations. You can have a savvy board, super savvy manager, knows what to ask for, communicates expectations to the agent. But if the agent does not know what is being referred to or what the coverage is that is being talked about, and oftentimes they don't, because they are generalist agencies. So they're going from a condo association to a restaurant to a homeowner's insurance policy to an auto policy. You may know what to ask for, you may ask for it, but that doesn't mean it's being delivered. And to try and audit that and scan page 147 of 162 page policy, it often doesn't happen. And so you can have all the right checks and balances in place, but you need to have an agent that knows what they're talking about, for sure.
Excellent. All right. So moving on. All right. So Chad is going to go over our core four, or the most important coverages. Chad, if you want to take it away.
All right, thanks, Tyler. And as Tyler said before, thank you everyone for taking some time out tonight to sit through this with us. As Tyler said, I'm going to go over what we call the core four coverages. The first one up is the property coverage. This one's it's the backbone of the coverages. It protects your buildings, common areas, amenities from covered losses such as fire, storm damage, or mechanical breakdown. Basically, if it's part of the property and it can break or burn, this is the coverage that would apply. I think that one's pretty straightforward. Next, we have the general liability. This is the coverage that would step in when someone outside your association or a third party gets hurt or encounters property damage while on site. Kind of think of this one as handling the unexpected trips, slips, or minor chaos caused by anyone visiting your property. Next up, we have the directors and officers. Like all of you current or former board members know that being on a board can kind of feel like trying to herd cats who all have really strong opinions. The D&O coverage protects your board members from lawsuits related to decisions they make on behalf of the association. It's kind of the legal shield for those of you brave enough to have said, sure, I'll volunteer. I guess an example of that would be the board decides to raise association fees over a surprise repair. Homeowner disagrees and sues the board, claiming the decision was unfair. The D&O is there to step in and handle those legal costs and protect board members from personal financial liability.
I do have a question regarding that.
Yeah.
Is there a recommendation that the individual board member also has error and admissions insurance on themselves, or it's not necessary?
It would not be necessary.
Okay, that's all I want to know. Thank you.
And the right D&O coverage will protect in that scenario that you provided, Chad. Not all D&O policies will cover claims that do not allege a monetary damage, right? So, you passed a resolution that bans certain breeds of dogs or weight restrictions. Well, if the claim doesn't say you cost me X, but we're not going to jump ahead to that. Kathleen, to your question, no, it does not require it, but what you do have to double check as a board member is if your HO6 policy, your personal liability policy, excludes or might speak specifically to whether or not you can be on a board, right? So most homeowners policy, liability policies do not limit our ability to act in the capacity of a board member for an association. Some do, but on the association side, that's not an issue.
Okay, I think I lost you on that. What's an HO6?
Your condo owner's policy, individual.
Okay, so my homeowner's policy.
Yep.
Okay, I will check that. Thank you.
Cool.
And the last of the core four that we have is the fidelity or crime coverage. This is a coverage that is in place. It keeps an eye on your funds. It protects the association from theft, fraud, or any financial shenanigans. Someone once described the coverage to me as keeping your cash safe from the sneaky, shady, and greedy. This can be a board member, a vendor, just anyone that is able to access your funds.
And that kind of add on what Chad mentioned there with the fidelity coverage, this is the money that you've saved up within your reserves. That's money that's generally taken years of contributions to your reserves to build up. This is there to protect that. And it also, it's not meant to be an exhaustive presentation, but it also goes towards FHA compliance with their general requirements as well. So we can go all night talking about that, but I won't bore you to tears with that. If you want to go in depth, please feel free to contact any of us.
I will real quick and just say someone out there in the audience is saying, well, why do we need crime coverage if we have custodians managing the funds of our association, right? And the answer to that is the premium of the coverage reflects the actual exposure. So fidelity crime coverage for associations is not that expensive. It is a requirement like Fannie Freddie, but also it's best practices. And the reason why you want that coverage, and it's, again, very affordable because the exposure is so limited, is so that you, the association, have the funds to subrogate if needed, right? It costs money to get money from somebody else. And without this crime coverage, you wouldn't have the liquidity potentially to incur the costs to hire legal and to go after and pursue, the actual party responsible for the theft of the loss. If questions on that, we encourage all the questions. You got all our emails, and we love it. So, all right, Chad.
Can we go to the next slide then? So these are the optional coverages. You probably not required to carry them, but it's definitely something you'd be grateful to have when you get a curveball thrown your way. First up, we have the workers' compensation coverage. This is going to respond to injuries to a vendor or someone a vendor hires that comes on the premises to perform work that doesn't have a work comp policy of their own. So, your landscaper hires a guy he knows to come trim the trees, falls from a ladder. If they don't have the work comp in place, it potentially could kick back to yours.
And if I can just quickly add to that, Chad, too, because we often get this question from a number of our communities where they don't have an employee and they'll ask, hey, why would I have workers' comp policy? Like, we don't have employees. And then B, when we sometimes reference like third-party vendors, we often get asked the question, well, don't you guys collect certificates of insurance and verify that the vendors with whom the association is working and you're dispatching are properly covered? The short answer to that is yes, we do. That said, some of the things that sometimes do happen in terms of curveballs that Chad alluded to might be, let's say that vendor provided a certificate of insurance and a copy of their insurance declarations for their policy that covers them for the next 12 months. And let's say tomorrow, for whatever reason, they get dropped or they, decide to terminate their policy suddenly or whatever the case might be. And there's, a gap in coverage that we, despite our due diligence, are not aware of. And somehow, that injury happens on site or some sort of issue that would be covered under a workers' comp policy happens. This helps to have that added protection. Sometimes it also helps in our experience because if you work with like a small like owner operator who doesn't have any employees, they're not always required to carry workers' compensation. There's often an exception within that. So in our experience, like again, it's not often that the workers' comp policy might come into play for you associations who don't have direct employees, but there are still, many instances of case law and issues that happen every year that folks at CRA, folks at a number of other agencies will inform us about that. Hey, you know what? Something happened. Someone's coverage wasn't what we thought it was. Another one that happens occasionally is like a board member performing a duty on behalf of the association. Let's say a board member volunteer gets on a step ladder, out of the goodness of their heart, goes to change a light bulb, and then suddenly falls. And now they're injured and there's, some level of recourse that they're looking for. That workers' comp policy is also additional coverage if something like that happened. So if you do have a smaller community, especially where an owner, a committee member, a board board member might be a little bit more hands-on than they are in more, sizable associations. Also kind of good backup to have in our experience.
And I guess similar to what Alan had said about the crime too, the premium is going to be based on the exposure. So if you don't have any employees, there's no payroll. It would be on an if any basis, and those policies are going to be $600-800. It's not a large premium that goes along with those.
It's not a large premium to a medium to large size community. Eric makes the best point for it. Definitely is helpful to have sort of volunteer workers' comp as a stopgap. If one of the volunteers doesn't have health insurance, or whether they have health insurance or not, I mean, it is an available coverage. But I will also agree and admit that if you have a professional management company that is, vetting to the best of their ability, right? I mean, they can collect a certificate from a qualified vendor that has everything that they say they have, and then tomorrow that qualified vendor says, I'm not going to pay my premiums anymore, and lets his policy lapse. There's nothing you can do to confirm, unless you were to ask for updated COIs every day, that there's no exposure. But now I will play devil's advocate for a moment and just kind of, no, I won't. As I say, I can go down the history of where the work comp policy, if any, came from, right? And it came from New York. Insurance is state regulated. Some states are much more litigious than others. It was a stretch, but some attorney was able to convince a jury that the association and other entities, but this one happened to be an association, had an obligation to the employee of any company that they contracted to ensure that employee was protected by appropriate workers' comp coverage. They did that, or we do that, but in this case, they didn't. And it was one of those scenarios where we got 2 bids for someone to come and fell a tree. One of them charged us $10,000. The other one was doing it for $1,000.
Wow.
We went with the one charging $1,000. Well, why do you think they were so much cheaper? There's a lot of reasons, but a lot has to do with insurance, bonding, licensing, permits, and other stuff. So in this particular scenario, it wasn't just, complete randomness. It was a case where, we were knowingly and intentionally going around, cutting corners and cutting costs. And it was a slap on the wrist. But that's, of course, didn't prevent a bunch of insurance. If I could start all over again, I would be a work comp, if any, insurance company, because they make a lot of money. Okay. It is quite the gig. And the minimum premiums are, $500-600, which doesn't sound like a lot unless you're a 5 to 10 unit association. And then it's like, well, shoot, and then what's the likelihood? I like to think it's a case-by-case scenario, because there's everything from full-blown urban communities with their own shopping centers and school districts, all the way down to the quad condominium that meets once a year to make sure that their quorum is met for the bylaws or whatever. But great question. I don't like it. We don't promote it. We don't, like, if we run across an association that doesn't have it, we're not going to shove it in their face. Not that we would shove anything in your face, but it was on a list of priorities of things that we're kind of checking our boxes to ensure, as long as they are managed by a professional management company like Westward, we're not going to really, scare people into, purchasing something that doesn't make sense. And I could go on, but I'm not. We're going. Keep chugging along.
Get these people to dinner.
Because it just gets it gets more and more
Information
exciting as we continue. Like it's a crescendo. So we're just getting started.
I have a question.
Yeah.
When I look at the documents from Westward 360, can I tell if we have these optional insurance coverages? I think some, like I'm trying to remember. I think workman's comp, we have that. I'm sure we have umbrella. I don't know that we have cyber, and I don't know if we have flood and earthquake. Is that something that would be listed that way? Do you know, on the documents that we get, or would it just say, you know, whatever the carrier is, and you wouldn't know whether it covered these things or not?
Well, and that would depend on the agent's like thoroughness and how they deliver proof of insurance.
Okay.
Flood and earthquake would typically be listed if it was there. Optional recommended coverages is recommended means it
Right.
might be worth looking and doing a cost benefit analysis, not necessarily, oh my God, if you don't have this. And then cyber, most associations have some built-in cyber coverage on their package policy, so it might not be readily apparent, but you can definitely ask the agent. And cyber, like crime, those two things, what they have in common is similarly, most cyber events are not going to be a breach in the association systems. It's not even often a breach in the management company systems. It's usually some sort of breach in a third-party provider. And so why do we need cyber coverage? Well, it's like $100, and we need it so that when we have to go after that third-party vendor, we don't have to come out of pocket for the cost to subrogate and recover our loss. So,
Yeah, and a lot of times the credit
Good question,
monitoring
Eric. I would-
services.
wish we could pull up a certificate of insurance specimen and kind of go through it together, but we can after this. So.
Yeah. And I will say on cyber, you know, a lot of times it's the credit monitoring services that come along with the liability that end up being the long-term costs. So it's really important, should you have that coverage, that's, you know, something that's baked in. And a lot of the coverage for the vendors, say you've got an online vendor that collects your dues payments, there's typically within the contract some sort of limitation of their liability. So again, it's nothing that is something we're going to shove in your face, but just for the educational purposes, it is there. It is something that we recommend if it makes sense to your community fiscally.
Okay.
Really good questions, though. Love
Yeah, I know. I don't know if I have to go with the cyber anymore. It's
it. Yeah. And Alan, you touched on some umbrella and flood and quake as well, but
no,
just, you know,
you'll have a good night. I'm gonna go grab a
Sorry.
bite to eat.
Are you?
Alan, you got this.
Yes. Which of these would not be readily apparent? So I kind of accidentally
jumped
jumped to
around.
the
Yeah.
B's as sorry. Jay.
Yeah.
Oh, yeah,
Yeah.
it's all
Flood
good.
and earthquake, though, you know, like, can it happen in Chicago? Yes, an earthquake can happen. Premiums are commensurate with the exposure, right? So, like, I'd be having the same conversation with someone in Seattle about whether they should or shouldn't have earthquake as I would, you know, with someone in Chicago or in DC, because they're going to pay $38,000 for earthquake coverage. We're going to pay $380 for coverage. So it's not like it can't happen, so we don't want it. Let's first see what it costs, and then maybe, you know.
That's what I was gonna say. I mean, it definitely warrants a conversation with your agent just to kind of see what it's going to cost, and you know, if it makes sense for you. I know one of my biggest claims I've ever handled was actually a flood claim in Chicago, where I think it was 21 when we had like all the rains for like 5 days in a row. The river went over one of the flood walls on one of the condos obviously on the river, spilled into an underground parking garage and the basement where all the mechanicals were hooked up. So like the National Guard came in to evacuate the building. We had over $50 million in losses and repairs. I mean, cars were underwater. People were misplaced for a couple months. So it's you know, it's one of those things you don't think Chicago flood or earthquake, but you know, depending on where you are and you know, with how funky the weather has been, it makes sense to have the conversation.
All right. So in the interest of time, I'll move forward. I think we labored that point pretty well. So, all right, this right here. Does this look familiar to anybody? if you're a community leader or manager, it probably should, because this right here is a snapshot of the insurance requirements within governing documents. So one of your responsibilities as a board, as a manager, is to ensure that your coverage is up to par with the requirements within your governing documents. There's one particular phrase in this that I want to really hone in on. It's this right here, for the full insurable replacement value. All right.
I just
So-
want to disclose, pre-disclosure, that this was one of the slides that almost didn't make it on. Tyler was he was starting to nerd out pretty hard, and I was like, Tyler, I don't know if they're ready for this.
Yeah, self-admitted insurance.
Like, please, this is important. I'm like, oh, all right, just do it quick.
So I think I fulfilled that mission. So anyways, just real quick off the bat, compliance definitely is not red tape. It's actually risk prevention in the long run. So your insurance coverage should match the rules within your governing documents, and your broker should not be guessing at what those rules are and trying to slap any coverage together they can. They should be knowledgeable about how to put together the correct coverage for this. So, first point, you should definitely align your coverage with the bylaws and or other governing documents, and also lending requirements. Nobody likes talking to John Q. Mortgage Lender from Rocket Mortgage for 45 minutes and arguing with them about the coverage being adequate. So let's just tailor the coverage to your governing documents and lending requirements. This protects you as community leaders by having your coverage fit to your governing documents. It helps you avoid liability in the long run. You avoid disputes with your unit owners, homeowners, lenders, any possible regulators. And then also it helps to ensure full claim payouts by remaining compliant with that. All right, so what's important with regards to governing document compliance for your coverage? Your key steps. You're going to want to verify that the required coverages are included within your program. So this is your property coverage, your liability, your D&O, your fidelity. And also there's going to be minimum limits and deductible thresholds. So if your governing documents require you to have coverage to the full replacement value, make sure that that's included. Have your broker tell you and verify for you that it is included. If anybody wants to talk about coinsurance, believe me, that was I had 2 other slides that got cut out because they're like, you're going to bore these people to tears. Feel free to give me a call anytime. I'll talk to you as much as you want about coinsurance. Who must be named as an insured under the policy? Obviously, your community is going to be named, but most policies written by carriers that are aligned to provide coverage for community associations are automatically within the definition of insured, or through condominium or HOA specific endorsements, they're going to include all members of the community. Each homeowner, each unit owner as an automatically insured as a dues paying member of the association. And the last thing, review and document your insurance alignment annually. Have your broker do that. That's part of what they're there for, part of what they're getting paid for. Part of what you trust in them is making sure that your coverage fits what's going on within your governing documents. All right. Now, moving on with D&O coverage. This protects you all as board members, community leaders, and managers. Board service is a noble undertaking, but it also comes with a little bit of risk. So as it says here, this protects your leaders. It helps you attract and retain those qualified leaders that are willing to lead your community. Legal protection allows you to be confident in the decisions that you make as leaders within your community. And then the last point, it covers good directors and officers coverage provides coverage for defense costs, settlements, and additional items for claims such as mismanagement or, say, a breach of fiduciary duty. And we are definitely going to go into what is good D&O coverage versus what is not so good D&O coverage. So again, I could talk all night about it, but we'll try to keep it short here. All right. So in bold right here, all policies are not created equal for directors and officers. You've got two basic types. You've got your package D&O, which is what you'll find typically most generalist agents may write. It's included on the package policy, so the policy with property and your GL via endorsement. Generally, these policies cost less, but it's much less comprehensive, and it can have some very significant gaps in coverage are possible just within the coverage forms. And then the second type is your monoline directors and officers. Some brokers will call it a standalone policy. These are much more customizable with tailored insuring agreements, and they're a lot more comprehensive. There are several community association specific programs that offer those, again, tailored insuring agreements to provide coverage and better protection. So overarching theme, if it sounds too simple, it probably is too simple.
Yeah. And it's not that the package D&O is intentionally bad or has shortfalls. It's a package D&O. A package policy is inherently designed to meet the needs of multiple commercial entities. So you might find like spoilage coverage on your package policy. Well, you don't have a walk-in refrigerator full of restaurant deli meats and tomato sauce. So you don't really need spoilage coverage. It's built in. Same thing with a package D&O policy or D&O coverage. It's there. It's written with the intent of ensuring a nonprofit. But nonprofits, as you know, come in all shapes and sizes, right? Some do fundraising, some have special interests, some are volunteer led, some are board, executive paid positions. Some have, mailing campaigns, some do marches and, travel all over the world. And then others, though, are volunteer board, not necessarily professional directors and officers. And the decisions that they make are not always financially impactful, but are challenged quite often because the constituency is a group of random individuals with their own interests, their own wants, their own desires. And the only common interest is you kind of share. It's a very important interest, but the common interest is that you share a living space, which creates its own unique challenges and flare-ups in terms of disagreement. And so having non-monetary damage coverage is the single most important thing to have and the biggest differentiator between the two types of coverages. The second, and almost equally as important, are claims alleging any sort of discrimination, whether it's unit owners or potentially tenants. I'm not gonna take this from you. Yes, keep going.
You're good. Big segue.
$1,000 policy and a $200 policy.
Perfect segue here. So yeah, like I mentioned, there's potential significant gaps in coverage under your package D&Os generally. The first one, like Alan mentioned, is discrimination. Some carriers will encapsulate this as a quote unquote civil rights violation exclusion is what you'll see it called under policies, but it encompasses discrimination. So if Karen Q homeowner wants to have highlighter yellow shutters on her home, and the board says no because it's not going to match the aesthetic, she could sue the association alleging discrimination because, say, she maybe has a health related issue or something. Most package D&O will not provide coverage for the defense on that, but if you have a standalone policy, it generally will. And then also the second one is the non-monetary damages. So moving ahead, most lawsuits actually don't demand some sort of monetary compensation for items from a board. It may simply be there was a board member that was unhappy about the results of a board election and they're no longer on the board. They allege that the association didn't follow the proper procedure and file suit. So, there's a bunch of different things that people can sue a community for, whether it's real or imagined. It's just very important to be cognizant of what you are protected for and what you're not protected for. So, main point here is read the fine print in your policy prior to a lawsuit arriving, because you'll be better prepared. So, yep. Any questions on any of that?
Nope.
Nope. All right. I'll take silence is golden. All right. So, Alan, this is your forte, that the market forecast and what we're looking at moving ahead.
All right. Thank you, Tyler. Well summarized. And yeah, I love doing market forecasts. I don't like trying to compound it into 2 slides. I'm an econ major, and actually macroeconomic trends in insurance fascinates me because there are hard and soft markets in insurance similar to ups and downs in any sort of market. But unlike the traditional like equities or commodities market, the insurance market shares some common trend. Inflation, interest, those kinds of things impact the insurance market in some ways, but in some ways they act as they act in a completely opposite fashion. And you'll start to see where I'm coming from in that regard. But we're coming out of a hard market. A hard market, quite simply, is when the capacity in terms of surplus capital shrinks, right? And all of a sudden the prices go up dramatically. Carriers pull out, so supply no longer meets the demand. And that's kind of where we are now. A soft market is kind of the opposite, where we're starting to get into it, we're turning into it, but the soft market we were in for almost a decade before 2023 is the result of carriers all attempting to essentially purchase or buy up the largest piece of the pie when the pie is at its smallest. So when you have major recessions, what happens? And companies begin laying people off. Their sales begin to drop. The amount of stock on hand is reduced. When payrolls go down, when total employee counts go down, so does payroll. When payroll goes down, workers' comp goes down. When sales go down, liability premiums go down. And that's when carriers get extremely aggressive with their pricing, because they're trying to buy or acquire the biggest piece of the pie when the pie is at its smallest. Because as the pie, our economy, begins to expand again, they will grow with it. So in a situation where we have, in the last 2 years, a perfect storm where both inflation and interest rates go up. Interest rates go up, and investors, creditors, pension funds, they pull out of what is traditionally, believe it or not, a conservative investment in providing reinsurance capital and chase better returns in a higher interest environment. So they extract all this extra liquidity from the reinsurance layer, which means carriers themselves, the ones issuing these policies to us, are limited. Their capacity is limited in terms of the number of policies they can issue. Compounded by inflation increases, where the value of the property that we're looking to insure, the cost to replace the property that we're insuring, goes up dramatically as well. All right. So we're in a situation, I'll actually include our 2025 market report. It's a 10-page document that explains the analysis. We look at consumer analysis in terms of asking associations and managers what their intentions are, what their sentiment is in the market, and we compare that to what carrier underwriting and actuarial strategies are. Last year was a wait and hold. So they're still writing a bunch of business from 3 or 4 years ago and waiting to see how that trends out. Most carriers stopped writing new business. So in Chicagoland, not last year, but the year before that, the addressable market went from 12 healthy insurance companies aggressively writing common interest communities to 5. Right now, that doesn't mean that 12 just canceled all their policies, but they stopped quoting and offering terms to associations that they did not currently insure. All right. And so they shut the tap off. So the 5 remaining carriers, knowing what each other were doing, sort of took a lockstep approach in increasing the premiums, knowing that they had these other 7 markets, or almost over 65% of the total market share was an attrition event where suddenly, let's just say 10,000 communities were all insured by 12, insurance companies. Now 5 are insuring it. You've got the remaining, policyholders all having to find insurance somewhere else very quickly. So you had a scenario where it was a name your price type of a situation. Now, the people that left the market, the very conservative companies and some of the more aggressive companies that just take a really broad stroke approach. I hate naming names and I won't name names. But a lot of the larger insurance companies that don't specialize will look at an entire industry class. We'll call it real estate. And it will be underperforming compared to restaurants and wholesalers and manufacturers. They're not going to dig in and see what the problem is and try and identify and isolate where the losses are coming from or where the underperformance is coming from. They're just going to say, we're not going to write anything that has real estate attached to it, or we're going to increase the rate 20%. So those carriers created a lot of problems for us. There's also the same way you can leverage investing. Insurance companies can leverage reserves by purchasing more reinsurance. And that's another thing that got us into this situation. Insurance companies being aggressive, overly aggressive in their investments, I like to call them, because they're actually purchasing risk, right? They got much more loose. They started purchasing more reinsurance so they could issue more policies. And then the reinsurance market dried up and they kind of left in a situation where they did things. Who here in the last 2 years felt like they got an unfair insurance renewal increase? And I'm not even just referring to homeowners association, I'm auto insurance, maybe your homeowner's insurance. That has a lot to do with the reinsurance market and the liability premiums when you have a limited amount of capacity. So I don't want to switch screens to share this market report, but we will send you out a report that includes every insurance company, their year-over-year growth in terms of policy count and their short-term outlook for the next 12 months. And what I will say in terms of 500-foot level, you can expect to receive an 8 to 10% increase in renewal terms without making any effort to negotiate a remarket. There's a big asterisk there. The same insurance companies that are going to be taking an 8 to 10% increase this year are going to be offering an 8 to 10% discount to those policyholders that they do not currently insure. So as with any shift in the market, what's going to start happening is company A is going to increase your premium 10%, but company B or company A for condo B, who they don't currently insure, is going to offer a 10% discount compared to what they were paying. And these can be two identical communities in every way, shape, and form, right? So they have a renewal strategy and a new business strategy. For new clients, they're offering significant discounts and starting to get aggressive, but they're still trying to get cute and increase renewal premiums because the renewal underwriters are incentivized very differently than the new business underwriters. The renewal underwriters are given a call to action at the end. Right now, they're probably talking this year. Okay, renewal underwriters, you are going to get an increase of 8% across your portfolio that you manage. Right? They're not how to get there. They're not prescribing, increases by community based on the community's individual risk profiles and performance. They're saying, I want an 8% increase. Right? And so the underwriter is going to try and get there at the end of the year. So they might offer 10% increase to one company or community. They might offer 2% or even savings on the other. Well, what's driving the decision-making of that underwriter in terms of their pricing strategies? It is the agent. The agent who is pushing the underwriter and saying, look, my client is pushing me to make sure we get renewal terms way in advance because they don't want to be, caught off guard. There is a direct correlation between increase in renewal terms and number of days before the renewal. The insured, in the case where you're a homeowner and you're getting an auto renewal or a homeowner's renewal, or in the case of a community association when the board or the manager or the agent puts the underwriter on notice and says, we want our renewal terms and we want it in a timely manner. I will tell you, if you take anything away from this presentation, one thing, take this away. Ask for loss runs. Loss runs are a historic record of the insured's performance, right? If you have a homeowner's policy, you have loss runs. If you have an auto policy, you have loss runs. If you have a community association package, you have loss runs. What this does is it puts the carrier on notice, it puts the agent on notice that you not are necessarily shopping it, but that you have the information that you need to shop it if they force your hand and provide you with some terms and conditions that, for lack of better words, suck. And it also makes sure that that underwriter, right? So now when the underwriter is looking at their renewal strategies and trying to figure out how they're going to please their boss and get to that 8% goal, well, they're not going to do it by getting your insurance premiums, right? They're going to get it from the association or the client that isn't on top of it, that isn't asking in advance, that doesn't bring up loss runs. I have this funny little 2-image meme where it's like a picture of your insurance agent before you ask for loss runs. And he's on the golf course trying to make a birdie putt, And then there's a picture of your insurance agent after you ask for loss runs. And he's like sweating profusely behind his desk, like working hard, doing his job. So that's kind of what, if I was to say like the market forecast, you can expect to receive an increase if you don't ask for loss runs at the very least. You don't have to do anything with them. It's funny. Just ask for them, and that's all you need to do. That'll keep them honest in of itself. But it also, if you do want to shop it, now is the time, because carrier A is going to be offering you a 10% discount while simultaneously offering an identical community to yours a 10% increase because they're the current carrier. Next slide. So that's wait, go back actually. So that's the negative outlook and what to do about it. Then the positive outlook is we do have new market entrants. We've got new carriers that are bringing in new products. It looks like we're getting a little more dovish, which should bring more money. After gold it finally finishes its rally, God knows when that's going to happen. We might see some flight to safety, and reinsurance is a really good place for institutional and pension fund level investment funds to secure.
Can you explain, I'm sorry, just succinctly, what a loss run is again?
Absolutely, yeah. So, and your agent will know what it is. So, your loss runs, ABC Condominiums loss runs, is a document that says in 2024 we had X number of losses. In 2023 we had X number. If there aren't any losses, it's going to be a pretty simple, clean, and short document, right?
Mhm.
But if there were claims, it'll say what type of claim it was, when it happened, and if it's a closed claim, it'll say the final paid amount. If it's an open claim, similarly, it'll have what's called a reserve, which just is an adjuster's estimate of what the cost of the claim will be once it's been adjusted and closed. And the reason why that's important is I, as an agent that might not be insuring your community, want to provide you a quote. Well, with modern technology, I can find out the number of units, the year built, the construction, all of those underwriting data points that I would need to provide a quote. The one thing I don't have, and the one thing the current carrier knows that you don't have unless you ask for it to adequately shop it, is the loss runs. When you ask for loss runs, what you're basically saying to the agent is, I'm going to shop this insurance. Just a heads up. And so when they receive it, they get all nervous, and then they're like, okay, here's the loss runs. You're not leaving us, are you? Or, sound the alarm kind of thing. And again, even if you don't intend to shop it, that simple email, we encourage all of our managers to do it as an SOP, just keeps them honest. We can set recurring reminders and calendars to just kind of like tweet like, hey, this is coming up in 90 days, send loss run requests. And if when they do it, it puts the agent on notice, and they might not, like it, but they'll be looking out for your community before they look out for someone who's not asking for it.
Just to ensure that I understand what you're saying is, we used to live in California,
Mhm.
and when we had the big earthquakes, a lot of insurance companies would not pay out. And what ended up happening, they would no longer cover earthquake coverage. So what they did was, companies that were offering earthquake coverage, that was a lot more expensive. So am I understanding correctly, is if they have more claims because of a big event, the insurance company can either not provide insurance at all, or they're going to raise their premiums.
Yes. So that's a different situation than what the loss runs I'm referring to.
Okay.
But what does happen is, carriers can become insolvent. And a lot of times those coverages like earthquake and flood, which is why we kind of highlight them for many reasons. But equipment breakdown, earthquake, flood, those kind of coverages are typically purchased by the insurance company somewhere else and then wrapped in. And so a very stable, established insurance company could be outsourcing their earthquake in an earthquake-prone zone and not confirm the financial solvency of that provider, and it ends up making them look really bad. And State Farm pulled out of California, some of you know,
Right. Yeah.
rather abruptly, and that actually had to do with regulatory issues. So behind the scenes, the reason why State Farm had to pull out, and because they could not take the rates they needed, they were limited by the state. All carriers, different states have different limitations in terms of what carriers can do. It's a consumer protection issue. And California said you need to position yourself and have the financial capacity to not increase your rates by more than 15% year over year. And State Farm said, well, in this particular case, the likelihood of this occurring, dry fires, is so high that we have to take at least 20% or we can't provide it. And they were limited by California to do it, and ultimately they had to pull out. Which I don't think was in anyone's best interest, but ultimately they were limited by not litigation, but law.
Right.
I got a raised hand here, Sanford White. Hit the raised hand function.
Yeah, Sanford, if you want to unmute yourself, because you're currently muted, to ask your question. There should just be a little microphone button towards the bottom of your Google Meet screen.
And I'll keep going, but Sanford, please, by all means, chime in as soon as you get the microphone figured out. And I will just say that the last sort of positive, might not sound like a positive thing, is the incentives to perform risk mitigation, which we talked about. Mary Lewis.
What is reinsurance?
Great question. So when the World Trade Center went down, unfortunately, ultimately that was a $1.1 billion just physical loss. Forget about all the other losses of life and income. And, it's unfortunate and tragic accident. Ultimately, 11 insurance companies were involved in paying out the loss and the damages in that event. And that sort of speaks to what reinsurance is. Many carriers, the ones that you see on commercials, the policy, the logos you see on the policies, they're the retail carrier, meaning they're the primary layer. But behind the scenes is a whole nother world with like Munich and Zurich and Tokyo Marine and all these other Axis Re, and these are multinational reinsurance funds that basically provide insurance to insurance companies.
Okay.
Yep. So I, as an insurance company, may decide that, I want to keep writing more communities or writing other stuff that we're profitable in, but in order to do so, we would have to put a lot of reserves in place that would otherwise limit how we deploy our capital and our investment strategy. So they'll basically buy protection as a stop loss that'll allow them to then redeploy the funds they'd otherwise have to park. It's dangerous. And the more we rely on reinsurance, the more uncertain, right, outcomes can be when the more effective we are economically. Great question.
Thank you.
Hey there,
And,
this is Sanford White.
Hey,
Can you hear me
Sanford.
now?
Yep.
Excellent. This is a great session, guys. Just a question about the loss runs. Is that specific to my community, or is that specific to HOAs in general? With my community experience, part of that loss run.
Yep, it is your community. It is a snapshot of the performance of your association. It doesn't benchmark or provide a ballast against the industry, but it essentially, yeah, your history.
Great, thank you.
Yep, absolutely. And carriers looking at a lot of different things on loss runs. Carriers would rather see one big claim than 3 tiny claims of similar, scope or definition. In other words, 3 water damage claims that cost $5,000 is actually looked at less favorably than one $200,000 claim, right? Because someone left the stove on. One being, severity, the other frequency leads to severity. And so that's a whole nother interest topic. So those are our positive outlooks. Now, those are our negative outlooks. Those are sort of the suppressants to the forward-looking statement for 2026. But it will be negated by incentives now that carriers have forms that have been.
I have to ask you this. I have to.
Yeah.
Because that was like you went through it, and I'm like, wait a minute. So you're saying that when they look at a loss run and they look at a $5,000 cost, for one thing, and then they look at a $200,000 cost for something else, they might more favorably look at the $200,000 cost than the $5,000 cost, just because of what the event is. Is that right?
So no, my speaker
Okay.
my speaker must have cut out at a very important word.
Oh,
And when I was comparing and contrasting those two scenarios, I said 3 small $5,000 claims versus 1 $200,000. The insurance company looks more favorably at the 1 anomaly, even though it is significantly higher than what appears to be a series of recurring, potentially correlated, smaller issues.
I see. Okay.
Yeah.
Sorry about that. Yeah, but I'm glad you meant. Yeah, you probably would have.
I was like,
you
what?
brought that up because then you probably would have thought less of me for the rest of this presentation. Like, this guy's crazy. Like, what's he talking about?
I will.
Yeah.
Yeah. I'm glad that got brought up just because I do remember, especially when I started in the industry, like almost 13 years ago, like going back to like that soft market that you guys alluded to. In my memory, I remember when like associations would file a lot more, like the frequency of claims filed that were like just beyond their deductible, or maybe they had a $5,000 and it was an $8,000 loss. Like folks would get pretty claim happy because the, at least at the time, the premium increases that often get, even for those petty, and like they weren't all that sizable. They'd expect the increase, but then it was like, hey, we got 5 to 7%. Like we can swallow that, and with the ability and liberty to be able to file claims when needed and not pay out of pocket. And then, especially as that transition happened, associations that tended to file those pettier claims that were only like a few percentage points beyond their deductible, then they were getting those really negative sizable increases. So we, for years have been trying to get boards to kind of rethink, hey, if you do have, let's say you're a small community with $1,000 deductible and you have a $5,000 loss, maybe conventional wisdom many years ago would have said, we should absolutely file this claim. Whereas now, if you have the $5,000 to pay out of pocket for that loss, it might potentially be the better financial move because that renewal that you get might be, leaps and bounds beyond what you were expecting. Like when we had communities last year, 2 years ago, that saw 40, 70, some of our communities got 140% increases on their policies not because they had huge catastrophic claims, but because they had a series of those petty kind of smaller claims that were just drove that price up, and the tolerance for it seemed a lot lower than it was maybe 5, 10, 15no years ago.
Okay. And the overarching theme is that frequency leads.
Kidding.
Yeah.
No, that's a very good point. I want to come back to the soft market.
Yeah. The overarching theme in the industry is generally that frequency leads to severity. And if there's a high frequency of claims, it could be a very good indicator that there's some sort of systemic issue. So if you're seeing a bunch of like smaller water leaks and you've got 5, 6, 7 water leaks on a loss run, it could be an issue that, hey, maybe the plumbing isn't in the best condition in this building. I don't know if I want to underwrite that. I don't know if I want to be the underwriter on this policy because the carrier is going to be underwater and it's going to be unprofitable. So, great points all around.
You have 5 or 6 claims, you're done. Now, in the soft market, Eric brought up a good point with the soft market. The reason why we didn't get hurt when we filed those smaller claims on small deductibles is because you had an overly competitive market. The supply was there to step in if something happened. But the other thing, it's not entirely the unit owner's fault. We see this in not unit owner, the association's fault, and we've seen this most impactful in 2 scenarios: deductible and umbrella coverage. So rewind, we'll even say as early as like 5 years ago to like 15, anywhere from that entire range. You had $1,000 deductible for your community association. You're paying $10,000, and the market was the conditions of the market were such that if you were to approach the carrier and say, "Okay, if I increase my deductible from $1,000 to $5,000, what will you give me as far as a discount on my premiums?" And instead of $10,000, they'd give you a $10 credit and only charge you $9,990.
Hmm.
It's like, wait a minute. I'm assuming 5 times more risk on first dollar losses, and you're going to incentivize me with a $10 credit? Like, no, I'll just keep my $1,000 deductible. And I know that's seems like an extreme example, but that's kind of what happened. A lot of associations considered early on, before the market got really hard, okay, well, maybe we will take our deductible up. Maybe it doesn't make sense to file a $3,000 claim on a $1,000 deductible. So if we're not going to file a $3,000 loss, why not take a $5,000 deductible? And so you go to your agent, what are you going to get? What do I get for assuming more risk? And the carriers weren't willing to provide a credit that's commensurate with, what the quid pro quo was messed up. Same thing with umbrellas. Gosh, I want to go back and punch me in the face 10 years ago that was like, hey, look, buy this $25 million umbrella, because it only costs $1,000. And at the time that made a lot of sense. But now with liability limits going up and you're paying thousands of dollars for a $25 million umbrella, I have yet to see, knock on wood, a non-for-profit volunteer community association be like found negligent and really had liability claims exceed, let's just call, I'm not going to go into what we recommend for an umbrella. But in other words, it was easy for everyone to get a $25 million umbrella and take on a $500 deductible because it was being given away for free. And now that party's ended and we're kind of adjusting to that. The last thing I'll say as far as positive outlooks, and then we'll move on, and we can, if you're interested, we can do like a weekly study group where those interested people we can talk about macroeconomic trends and insurance premiums and butterfly effects and whatnot. But anytime something changes in the world, insurance carriers are the last to respond because they have to file forms that need to be approved by not one government, but 50 governments. Right? 50 insurance commissions of 50 different states to get caught up with filing their intended position on any number of changes. Drones, for example. Now it's electric charging stations. Last year it was solar panels. This could be a whole nother topic of discussion, but if you haven't yet installed electric charging stations at your community and you're thinking about it, just check with me first. Maybe, ask the insurance guy what the insurance company might think about sticking a bunch of $5,000, 1,000-pound batteries running 10 million gigawatts, in your basement, in your common shared garage. But so why is that relevant to this? Well, carriers have now filed forms that have allowed them to allow their clients to assume more risk. We've all seen the per unit deductibles, increase in general deductibles. We've seen actual cash value roof endorsements to disincentivize people from answering that door when someone comes knocking and says, look, you might have hail damage. You mind if I go up there and take a look? And, we'll get that thing covered. That was an issue. So those were other things that, that we're on top of. So the market forecast, I intend to get my clients flat to adjusted for inflation, 3 to 5% increases. I look to get anyone that's not my client anywhere from 10 to 20% decreases. That's not a pitch. I'm sorry, it might have sounded like that, but that wasn't the intent. But that's
I got excited.
The market condition is such that it's going to reward those that are proactive, and it's going to pass the costs savings of those that are proactive on to the people that aren't. Right. Next year looks a lot better as well, but market, money's coming back, flowing in. but definitely consider the deductible as a consideration that we're going to talk about later after our 9 p.m. break. Just kidding. It's yeah, after the 15-minute bathroom and dinner break. No, okay. I'm going to move on. Any questions you all have about the next 12 months, let us know for sure.
Yeah.
Oh, and now we've got reserve studies. Yeah.
Yeah, I'm gonna just fly through this real quick. But like Alan said, being proactive, being ahead of the curve in terms of your insurance, your reserve study is, everybody here knows what a reserve study is generally. It's like the long-term financial plan, determining when certain components of your community need to be replaced. That should really be a guide. Being proactive gives us as a broker so much more quote unquote ammo when going to different carriers to negotiate rates, negotiate those more favorable valuations. Just the proactivity looks really good when you're discussing with underwriters. So that's just a general guideline. Moving forward from that, any items you're taking care of in terms of your maintenance plans, please let me know. Again, even if you think it's something minor, it may not be as minor as you think. And any amount of ammo I have going to my underwriters can justify a lower rate, or I can use it to leverage quotes and improve your overall position. So again, the reserve studies, it helps you avoid those unexpected expenses. Nobody likes to have a special assessment to replace roofs. The reserve study is a key to making sure you're properly funding your reserve to take care of those expenses and keep your property in good condition. A carrier is going to feel much more rosy about insuring a building that's in great condition than they are about one that's got, cracks in the roof and is falling apart. So again, just best practices, maintain your property. And then, all right, the last part, and I'll start off on this one, and hopefully Alan doesn't come in and crush.
No, this is important. Let's save it. Let's save. We'll save the shameless plug if we have time. No, but do read this. There is truth to it. Access is real. Knowing where to find things that are impactful and material is real. Having a team and the systems in place to get in front of renewals and not let underwriters take our clients for granted. Those are all real reasons why you should work with a specialized broker. That's the future. Main Street, mom and pop, works for the small towns, rural areas where, everyone's got that local insurance agent. Not putting those people down, but everything has become more specialized. So, yeah. Next slide.
Yep. And then this is just a way ahead. Best practices, feel free to reach out to your broker, or heck, reach out to us. Even if we're not a broker, we can give you a free coverage analysis and just give you a general opinion and advise on a way ahead. It helps put your community in a better position. So whether we're the broker or not, free of charge.
Consider claims impact, which Eric already mentioned.
Yep.
Now is not the year to file a claim. You don't have to. If you are claims free, that's great. You can afford to file a claim. If you have had a claim in the last, I'd say 24 months, you want your first claim to be that get out of jail free card. Everyone gets a get out of jail free card. So you want the get out of jail free card to be a $20,000 claim on a $1,000 deductible, not a $3,000 claim, because the next time you have a claim and it is $20,000, you don't want that to be your second or God forbid third claim that you have to file because you no longer have the power of decision making on your side. Review your D&O coverage. Ask your agent whether or not, whether D&O, earthquake, flood, umbrella limits, deductibles, your agent can provide you with alternatives, whether you bid it or not. They should. And then underwriting outcomes. and strength of financial planning. We've talked about that, I think, enough. What's the next slide?
Yeah. Basically, supply and demand. And then the big one that Alan said, if there's one takeaway from this, ask your broker for loss runs 90 days out from renewal. It's a general indicator. Your broker is going to immediately send a submission for your community to pretty much every market they have, so they can preclude other agents from securing that market that may actually be a better option. So they will work much, much harder for you, which is at the end of the day what they're supposed to be there for. So, and yeah, trust but verify. Not every broker has access to every market. You can trust that your coverage is in the best place, but also verify as well. So
Yeah, if your insurance agent says, I marketed this with all the insurance companies, what they mean to say is that they've marketed it with all the insurance companies they have appointments with. So the best carrier could be out there, but I, as the agent, if I don't have the appointment with that carrier, I'm not going to tell you that, right? Because if I don't have an appointment with them, then you've got to get them from somebody else, and then I lose you as a client. So there's a moral hazard there. And then honestly, there's a moral hazard in renewal versus new business strategy. We talked about how insurance carriers have renewal underwriters with their own objectives and their own requirements, and then new business underwriters. Insurance agencies are built the same way. You know, they're built to bring in new clients, and most of them take a very different approach to their renewal and retention of clients. And so when we say trust but verify, we mean like consider an alternative agent, not just another carrier from your agent, and that means us too. So if you're lucky enough to be considered one of our clients, put us to the test every couple of years as well. So.
Yep. And then, again, conclusion, insurance is a key piece of governance for your community. Align your policies with the risk involved, act proactively, work with the specialist brokers. You wouldn't have a dentist doing knee surgery. Why would you want a generalist agent insuring a niche market in the condominium or a homeowners association? Contact your broker to conduct an annual coverage review. Heck, even if we're not your broker, contact me and I'll be happy to go over with you, because that gives me a chance to develop a relationship with you as a board. So hopefully one day you will be my client. I will be the broker for you. So if your broker's not, checking that box with you, maybe look into getting a new broker, because there are specialist brokers out there that are happy to do it. And then again,
More? Are you sure you're not going backwards in it? Is it?
no, I went forward and I think it just got added in.
Yeah, I was good. Surprised there's more, and I was like, no, there's not
No.
more. Please, no.
No, I think we've already bored these people enough for long enough, and we're going to let everybody get on with their night. But if there's any questions, feel free to reach out. Here's our contact info.
A lot of people disappointed here, but I'm going to stick around. We'll stick around for Jan and Mary's questions and any other questions. We're also going to run a Amazon gift card giveaway for all the participants. We wouldn't do it live and keep you all around even longer, but we're gonna try and show our appreciation for everyone that attended.
Anybody sat through Alan?
Thank you, Eric.
Dissertation.
Yeah, thank you guys. I appreciate board members staying on for the longer presentation. I know we went longer than we usually do, but insurance is a complex one. I think especially since it's budget season, it's timely to be able to consider these things, regardless of when your upcoming renewal policies are, because you can still request this information and dive into it. Even, maybe you renewed last month. It doesn't mean you can't have a good conversation about your coverage now. So do take their advice there. But yeah, we'd love to get into some of the questions. I'm not sure. Mary Louise, you had your hand up from earlier. Do you have an additional question, or is it your hand still up from your earlier question?
Oh, I didn't know I had to click it off.
Oh, no, all good. So Jan Nelson, what was your question?
So Tyler really hit the nail on the head for me, because my board and association has had the same agent for a very long time. But we've made a lot of other, let's say, administrative changes over this past year. So anyway, to me, the analysis of knowing what my building really needs, because otherwise, how can you even really intelligently shop? You know what I'm saying? And as you say, some insurance agencies have different specialties, and what's appropriate for a community association is not appropriate for, ComEd, whatever. Okay, so with that thought in mind, especially if this is something you're willing to do without, major financial investment, because the truth is our building is small, and part of doing the research, we're kind of stuck doing it ourselves in our ignorant state of being, and having some form of guidance in the process would be most helpful. So anyway, I just would like to take you up on your offer.
Yeah,
Please.
Jen.
Yeah.
I was gonna say, definitely, reach out to me via the email, and we can set up a time to talk, or I can come out and visit, or just can take a look at what you have and make sure you're in a good place.
Yeah.
Yeah.
That would be great. And if I understand the process, so once we have that information, okay, and I understand too that a lot of insurance underwriters don't like to give you any kind of quotes until you're within like 30 days of renewal, because that pricing can change, which means that you have a limited period of time to make a lot of comparisons, right? But
Yeah.
you're going to be doing most of that effectively once we have a plan in place, right? I mean, that's kind of how it works.
Yeah, so you typically in a bidding process, obviously it works best if you're, 3 months out from renewal of your policy. But, just like Chad said, part of our job here at CRA is to be a trusted resource and appreciation. Westward does a great job, and part of our partnership with them is to be a trusted resource. So free and unbiased coverage review, because we want educated board members. We want the board members to be educated so they can make those educated decisions. So, but feel free to reach out to Chad or myself, or even on our website, you can go to communityriskadvisors.com and actually schedule a meeting with any of us. We're happy to go over that topic with you. So
Yeah,
just look to our calendars.
Our website has access to real-time access to all of our calendars in there. Schedule a 15-minute call and we'll be there.
Yeah. Well, in our little building, and the one thing I thought was very interesting is to make sure that the type of coverage that we need is being determined by what's in our governing documents. I thought that was very interesting. And I'm not sure that I've ever had an insurance broker for a community association say that to me. There have been times, and I used to be a manager, when I literally had to mention it to them. Okay. So with that thought in mind, it seems to me that sometimes this gets approached backwards. You got to know what the building needs first.
Yeah, absolutely. Right. I mean, to issue the appropriate coverage, the agent absolutely should. Unfortunately, the barrier to entry, I've been trying for a very long time. I'm on the board of directors of the Professional Insurance Agency, which is like the governing board, and the threshold or the barrier to entry to get an insurance license is, I don't even want to get into it, but suffice to say, any of you could become insurance agents. And so, in that scenario, there's a lot of moral hazards, and an insurance agent is not going to tell you they don't know what they're talking about.
All right. Well, I will be in touch with one of you.
Thank you.
Please, yeah.
That'd be great.
Looking forward to it.
Here, so
Yeah. Every community is unique. There's no cookie cutter approach to this. So yeah.
Thank you.
All right.
I do have one last question, and then you can go.
Make it a very tricky curveball one that
It's gonna be. I think it'll be pretty easy. So
deer in headlights.
Flex my insurance knowledge muscle.
yeah, I just want to see what you think. So next year, you're saying, we ask our current person for the loss run, and we see what kind of pricing we're going to get. Maybe we're going to shop it out. And I don't think we've ever used our insurance at all. So I assume that if you haven't used your insurance, that's looked on very favorably.
Yes.
And so we would maybe get a better price from them just because we haven't used insurance. We are planning on doing a complete tear off of the roof and having it replaced. Does that hurt us or does that help us?
Well, so it will help you to have a new roof depending on the age of your current roof and the proximate cause that's driving the roof replacement.
It's just old. I mean, it's
Good.
like
Then,
45 years old. And
absolutely, and that's an important question, right? Because let's say you're in the middle of it, right? A lot of capital projects happen in phases. Hopefully not the roof, but like half the roof, the other half's wide open. But other things like electrical, plumbing, that kind of thing happens in phases. An underwriter can get approval to underwrite it as a new system, whether it's roofing, electrical, plumbing, HVAC, as long as they can document or show evidence that a statement of work has been signed, or even to a lesser extent sometimes that you actually have bids from qualified vendors to perform the work. And so if you're in E&S because you had a roof leak claim a year ago, and I'm not saying you did, but you've got to make some big capital improvement. You're in the E&S market, or you're perhaps paying a big premium because you need to make this happen. Working with the right agent that understands how the underwriters are underwriting things and what kind of documentation they can use to justify writing something or providing a discount that they might not otherwise be able to until it's done.
yeah.
So yeah.
Now, if you show that the work is scheduled, would that be good enough, or would it have to be finished for them to really consider a lower?
No, I mean, if you get even if you have like a signed statement of work that demonstrates reasonable intent or certainty that it will be completed. Now, if it's like a signed, contract to begin December 2026,
right,
that will not hold as much weight. But yeah, I mean, if
it was like March,
right? No, if you have something signed in March, ideally maybe there was a deposit. It varies. I mean, that's what you rely on a good broker for, right? And a good broker isn't someone that just has appointments with certain carriers that knows insurance. It is someone that kind of gets inside of the inner workings of the insurance companies that they work with and tries for questions and caveats and exceptions to the rules, right? It's like actually advocating and twisting arms. Just fun for us. But.
Favorite part of the job.
Okay. So you think
but ask for loss runs,
yeah,
and don't wait for them to provide renewal terms.
Right.
Those are two separate suggestions. If you ask for loss runs, you're letting them know that you have leverage and you may be shopping it, which is going to keep them more honest with the renewal terms they provide. Doesn't necessarily mean that they're going to shop it. So you should use those loss runs and shop it if you haven't in the last, I would say, 2 years.
Is there loss runs for every type of insurance you have, or is it for everything?
There is for all policies.
Okay.
But if you ask for loss runs, 95% of the time, the insurance agent is going to send all of the loss runs. But the loss run we really need is the package loss runs, which includes the property coverage.
Okay.
D&O, umbrella, crime, we can click a little radio box that says we've confirmed with the insurer that they're not aware of any claims, and that's acceptable. Only for the property, which is like the meat, they want to actually probably see a document.
Okay. There's a person who works with that I've talked to. I can't remember what company. She does like the our statements, our insurance statements that we get each month. And I talked to her. Is she the person that I would ask for the loss runs, or do I need to go to the actual each broker?
No, you would just need to go to the agent or the broker.
Okay.
It'll be on them to go to company A, B, C, D, and E.
And ask.
Yep.
Okay.
Yeah.
Okay.
And I will give a quick little plug here for Westward 360. Westward 360 has an insurance coordinator that helps to centralize the insurance process. So if that contact information is on file within the system, she can help with asking for that too and helping
Okay.
you guide you along every step of the way. So a little plug there for our friends at Westward.
We love you, Samantha.
Well done.
Yeah.
Appreciate the opportunities. Keep it coming.
Thank you, guys.
Thank you. Appreciate it.
Jan, did you have another question?
Oh, I don't.
Okay, just making sure.
Yeah. Oh, sorry. I
No,
forgot to
you're
look.
fine. Any other questions we didn't get to, or any other comments from folks before we wrap for the evening? Alrighty, excellent. So thank you everyone for hanging on for a longer discussion. I'm actually happy to see that a lot of folks did remain on, because I think that's an indication that if folks felt like the content was really just helpful, informative, obviously timely in terms of your budget planning and any of you that have renewals coming up. So thank you immensely. Again, Tyler's, Chad's, Alan's information has been shared a bunch here. We will, when we distribute the recording to everyone, we'll also just include all of that just as a reminder so that you have it. We'll include a copy of the presentation as well, just so that you can reference any of the slides and things like that that might be helpful as you kind of ask questions of yourselves amongst your board, if you want to share that with other folks. And then we will have the recording also embedded into the education page on the Westward 360 website. So we will have that available for just future reference. If you ever want to go back to the recording, hone in on a section of the conversation that you found, particularly compelling. So that'll always be there in perpetuity for you guys to reference. And then for any of, I know that we had some folks, I'm not sure if they're on the call, that sent in some pre-submitted questions. We'll go through any of those, and we can probably include some short form answers when we redistribute everything to just any of the questions that we didn't really touch on. So Tyler, Alan, Chad, and myself can kind of run through those. Any topic we didn't get to, maybe we can just supply some short form answers that we'll just send along to everyone when we distribute the recording and the copy of the presentation as well.
And I just wanted to say thank you. It's been a very informative meeting. I was very impressed.
Yeah, it was great. It
Excellent.
was great.
Educated clients are the best clients, because insurance is complicated, but if we know that you know, then we don't have to worry.
Yeah. It's
Thank you
complicated, but
all.
it doesn't have to be.
Well, when you get on a board, you don't know what you don't know, and like our board is very small, and we've been at it for 3 years now, but it's all individual homes here in our little community. And so we don't have to face a lot of the condominium and townhouse problems, and great big huge associations. But every time I come to one of these meetings, I learn something. And so good.
Excellent.
Thank you all. You did a good job.
Schedule a meeting with us. We'll make you an expert.
Well, you just keep on
You
emailing
get
me.
your
those
insurance. You get your insurance license.
Okay.
Thanks, everybody. Have a good night.
Thank you.
Good night.
Thanks, everyone. Have a good evening.
Bye-bye.
Bye-bye.